Namaste and welcome to VD Decode YouTube channel.
7 out of 10 middle-class Indian families are walking a financial tightrope. They are exactly one medical emergency away from wiping out their life savings. Many rely on the 5 lakh rupee health cover provided by their employer. It feels like a safety net, securely catching you if you fall. But that safety net is tied directly to your employment contract. The moment you are laid off, take a career break, or retire, the exact times you might need medical care the most, that coverage vanishes completely. Even if you bought a private retail policy 5 years ago, those fixed limits are likely frozen in the past. A 5 lakh rupee cover bought in 2018 simply doesn't carry the same purchasing power in today's hospital wards. If your entire healthcare strategy is built on a stagnant policy or tied to your employer, you aren't actually protected. You're just hoping you don't get sick at the wrong time. While general costs grow steadily at 6%, the line shooting aggressively upwards is medical inflation, compounding at 15% every year. A procedure costing 5 lakhs today will double to 10 lakhs in 5 years and push past 20 lakhs by 2031. This surge is driven by the cost of care itself. Indian hospitals rely heavily on imported high-end medical technology. From robotic surgery bays to targeted biologics, you are paying for the massive infrastructure required to keep people alive. Your insurance policy does not automatically increase to match these rising costs. The widening gap between your frozen sum insured and the actual hospital bill comes straight out of your pocket. If your coverage isn't structured to outpace a 15% annual inflation rate, a single serious illness will eventually drain your fixed deposits and force you into debt, which leads us to the most expensive financial mistake Indian families make, combining life insurance with wealth investment. This matrix compares standard life insurance products. If we look at the endowment or money back column, you are locking your money into an asset that yields a 4 to 6% return. That fails to even keep pace with standard inflation. And to get that meager return, you are paying a massive premium, often 4 lakhs a year, for a dangerously low 10 to 15 lakh death benefit. Unit-linked insurance plans suffer a similar flaw. Your early returns are quietly hollowed out by heavy mortality and allocation charges before your money ever hits the market. Now look at pure term insurance. Because there is no investment component, you can secure a 1 crore rupee payout to protect your family for a fraction of the cost, often less than 1,000 rupees a month. The second half of this equation is taking all that premium money you saved from avoiding an endowment plan and diverting it into a mutual fund systematic investment plan targeting 12% returns. When an agent pitches you guaranteed returns, the only true guarantee is that your money will lose its purchasing power and your family will be left underinsured. Upgrading your health insurance to combat medical inflation doesn't mean you should go out and buy a massive 50 lakh rupee standalone policy. That ties up too much capital in annual premiums. Here is the optimal structure for a family living in a major city: a layered pyramid. You build a foundation with a standard 10 lakh rupee base floater and place a massive 50 lakh rupee super top-up policy right on top. The super top-up has a deductible. It only activates after the 10 lakh rupee base is exhausted by a major medical bill. Because the top-up insurer only takes on the extreme low probability risk, your total premium drops by up to 60%. But even a 50 lakh rupee cover is useless if you fall into the room rent limit trap. This diagram shows what happens when your policy caps your daily room rent and you choose a room that exceeds it. The insurer doesn't just deduct the room difference. They apply a proportionate deduction to the surgeon's fees, the ICU charges, and the diagnostics. You end up paying a percentage of the entire hospital bill out of pocket. Smart structuring gives you 50 lakhs of total coverage for the price of a 15 lakh policy, while completely bypassing these hidden deduction traps. Insurance should be a calculated decision, not a panic buy. Every March, agents weaponize the Section 80C tax deadline to lock clients into 20-year liabilities, just so the buyer can save a few thousand rupees in taxes today. Buying online carries risks. Digital platforms use basket sneaking, automatically adding unneeded riders to your cart right before checkout, pushing you to overspend. But the most fatal mistake happens on the application form. While most claim disputes can be resolved, hiding a pre-existing disease guarantees a rejection. Declaring conditions like diabetes or hypertension is mandatory because insurers apply a 24 to 48-month waiting period before they will cover treatments related to those specific diseases. Securing a slightly cheaper premium by omitting your medical history ensures a 0 rupee payout right when you are lying in an ICU bed. Here's a blueprint allocating a $10,000 budget across health, term life, and SIPs. At 25, with 0 dependents, cover base health and push capital into SIPs. By 35, a family demands a 1 crore term cover. At 45, aggressively transfer rest to protect built wealth. And if you are worried about your term claim being denied years down the line, remember Section 45 of the Insurance Act. Once your policy has been active for 3 years, the insurer cannot question it for omissions. You can also attach a critical illness rider. This pays out a direct lump sum upon a severe diagnosis, designed to replace your lost income during recovery, completely separate from your hospital bills. True financial security doesn't come from buying every bundled product a bank teller offers you. It comes from strictly separating your risk protection from your wealth creation, building a firewall around your family's future.